Welcome, Scott. So our next presenter is Scott Sandlin. And is Brant going to join you?
I have a whole group of people here. Gary Head. I've got the entire team here.
Oh, fantastic. So just, have them introduce themselves as they come on. Scott is the Chief Strategy Officer for White River Bank Shares, which trades on which is their business name, Signature Bank of Arkansas. And it's an exciting growth-oriented story, Northern Arkansas, trading around tangible book value, has a seasoned management team, and Scott and some of the others on his team have roots in the Walmart. Graduated through the Walmart School of Business, and so you got a lot to say, so I'll turn it right over to you, Scott. Thanks so much.
Thank you, Ian. It's great to be here and great to introduce this great group of people that I have with me today. We're very proud to be presenting on this conference and take it very seriously. So I'm going to turn it over to Gary Head, our president, CEO, and chairman of Signature Bank of Arkansas, and he's going to talk a little bit about White River, and we'll bounce this around a little bit so everybody gets a chance to kind of have a chance to talk.
For any new attendees who have been coming in, we are posting in the chat section one-page financial summaries of the presenting banks, and you could also download it from our website. Thank you.
Good morning, and thank you for having us. We appreciate very much the opportunity to tell our story. We're a bank group, a little over 900 million in assets that we began in 2005 here in Northwest Arkansas. Most of us have been in this market. Two of us in particular have been here almost 40 years in this very market. And so we're happy to be in one of the fastest growing areas in the United States. Northwest Arkansas is home to the University of Arkansas. Fortunately, we have a good football team. So the Razorbacks are that's our pro team in our state of Arkansas. We have offices up and down the highway here in Rogers, Bentonville, Springdale, and Fayetteville. We're excited to announce a new location open next Friday in East Rogers. In Northwest Arkansas, we're the home of Walmart, the home of Tyson Foods. Besides the University of Arkansas, we have J.B. Hunt Transport. Those are three of the largest companies in the country at what they do. Fortunately, we try to bank all of those people that work there that make a lot of money. Our bank is a business bank, primarily in high net worth type clients. We have one location in each town. We're really good at electronic banking and business banking, and that's our primary focus. We also, in this area, because of our labor, we have an enormous number of Hispanic population that is large and is growing. The last census in 2020, we had 100,000 that filled out the census. My friend, the Congressman Womack, tells me, and the mayor of Rogers, that we feel certain that was about 50% of the population that actually filled out the census. Arkansas got a demerit for being more than 6% lower than the census for 2020. And so we are opening a Hispanic bank, Banco C, next Friday in downtown Rogers, which is one of the two cities that has the school is 47% Hispanic in Rogers. And so we're excited. We have a gentleman, Francisco Herrera, that came out of Walmart, that was in the accounting area. And then we have an entire Hispanic team of people that are going to be offering our banking services in Spanish to those parts of our market that are more comfortable speaking Spanish than English. And so hopefully this time next year when we have this party, we'll have great results to talk about. The other two new locations, we opened a new location in Harrison, Arkansas. Harrison is about 50, 60 miles to the east. Harrison is a place that we began as a loan production office when we started this bank. We have a large number of shareholders in that market. Harrison has $1 billion in deposits, and we hope to take more than our fair share of those. We've opened in an old bank location that part of our bank family actually built, and we're excited about that. We're off to a great start in that market. The president of that bank, a young lady that worked for me in college, graduated, and so it's like old family week, and in a small town Arkansas that sells pretty darn well. And then we also opened in Jonesboro, Arkansas. Jonesboro is in northeast Arkansas. It's the second fastest growing portion of our state. We hired a very attractive group of people that came. The president came out of Bancorp South, many years experience in that market, graduated from Arkansas State University, which is in that town. And he's assembled a team of very experienced bankers that worked at different banks in that town, but have one common goal, and that is to have the best community bank in that small community. And so we're excited with our opportunities of where we already have markets and the markets that we've just entered. And so I'm going to let Scott or Brant talk about the next piece of our business.
All right, we're going to let Brant talk a little bit about low cost deposit growth and kind of what's been going on there, and then also expand on our growth plans.
Thanks, guys. I'm Brant Ward, the COO at Signature Bank. So as Gary alluded to, we've got mature markets in Northwest Arkansas that we really have pressed for deposit growth there based on the local market growth. And that really started about 6 years ago, where we really focused on bringing real deposit relationships. And our calling card there would be treasury management and electronic banking. And so when COVID hit, it really gave us a good chance to take some market share away from the bigger banks as they struggled to close lobbies and really service customers. So frankly, the customers we'd been calling on for a number of years, all of a sudden found it as a much easier transition to come to our digital platform, where we could remote onboard customers and really be able to serve those folks in a much better way than they were getting at the big banks. So you would see that deposit growth happening in our balance sheet. But then, as Gary talked about, we've gone to Jonesboro and Harrison and now East Rogers. And we have two purposes there. One is to have another deposit growth area, but two, we're really looking for the right bankers to serve an underserved market. And when I say underserved, both Harrison and Jonesboro and Northwest Arkansas have an incredible amount of banks, but there's really only a couple of banks that are servicing clients the way we are. What we're really looking for is markets where the big banks are just getting bigger. And so they're, again, struggling to service the clients that we really focus on. And then you have smaller banks that are really trying to step up in weight class that struggle to do good sized loans or even have the expertise in more commercial real estate rather than where they've come from. So Jonesboro, Harrison, Bunko C fit all that criteria all the way through. And so not only are we going to get a good push in Northwest Arkansas because we continue to have an inflow of people to the area, but our treasury management platform and our teams that are in those markets are really have really done really well. And so we opened Harrison last year in the fourth quarter, Jonesboro in the first quarter of this year, and Bunko C next week. And all three are ahead of budget and moving in the right direction. So that kind of takes the deposit growth. I believe we had a question around core conversion in the middle of COVID. So we embarked upon a core search right after COVID hit. We employed a consulting firm to help us look at that. So what we were looking for was something, at 800 or 850 million would give us the scale to be able to grow to $1 billion, $2 billion, $5 billion, $10 billion. And so that was kind of the mindset that we started off with. We employed a group of about 18 people internally to make sure that we picked the right product. And then we went to work trying to evaluate. And so one of the real questions was, how do we go evaluate these platforms when most everything was shut down? Fortunately, we had a couple of banks that would allow us to come in and talk So we feel like we cut to the right core. We eventually picked CSI as the partner, basically, and felt like we were putting ourselves in the right position to scale, not only on the core side, but also on the digital side as we think about open banking going forward and being able to plug in a fintech as we needed. So I would say where we are right now is we're 8 months into the core conversion. The conversion, as traumatic as those things are, could not have gone any better. But we're really taking the last half of this year to clean up process and procedure to get us to a spot where we can scale. We did just raise $15 million in sub debt to add to capital. So we feel like we are in the right position at the right time with the right systems to be able to scale what we have going on. I'll turn it back to Scott.
All right, I'd like to, Julianne, if you could go to page 16, I'd like to introduce Jeff Malin and talk a little bit about our overall loan mix and kind of visit with us about that. Jeff?
Thank you, Scott. My name is Jeff Malin. I'm the bank's chief risk officer. Looking at our loan mix here, you can see ending the quarter there at $719 million. We, as Gary mentioned, are heavily a commercial bank, primarily dealing in commercial real estate, and also heavily invested in the construction in our local area. I think it's important to see there at 135% of capital at June 30. We're unlike a lot of banks in that we primarily participate in 1 to 4 construction. We have much more of a concentration in that as compared to large commercial construction projects or to raw land loans. I think that's one thing we experienced in the past that we learned from, is that large tracts of undeveloped land are what gets you the most when things turn on you. So we have a really good portfolio of lenders that we feel good about. The supply in Northwest Arkansas continues to be an issue, specifically on the lower end, and we try to focus on what we can do to help there to service our customers in our community. We continue to watch that construction number as it gets a lot of scrutiny from outside investors and from our regulatory partners. We had great conversation just this morning in the context of, as we evaluate loans, given the current economic situation, where is the location of the project? Is it close to the main arteries, the highways? Is it an attractive location? Is this person a professional seasoned builder, or is this more of a hobby, kind of an offshoot thing? Obviously, those are different things in terms of attractiveness. Are we pricing the risk appropriately and getting enough of a return? That really needs to be a focus for us as we enter in these rising rates, and it continues to change. And then are we asking the borrower to put enough personal commitment into the projects? And so we are very heavily invested on personal guarantees and asking our borrowers to put money into the project. And so while we do have an elevated level of construction lending and really overall CRE, we do feel good about our process. We've learned a lot over the years. Brant mentioned we did get an influx of capital through the sub debt raise. That'll help those ratios coming up in the third quarter. And through all this, as we've evaluated and tried to really tighten some underwriting and make sure we're making the best decisions, we've been blessed with some really good demand here lately, and feel really good about where the portfolio is going. I'll pass it back to Scott.
All right, we're going to have Brant talk a little bit about page 18 and net interest margin.
All right, thank you, Jeff. So net interest margin, this accounts for about 78% of our income here. So it's one of the biggest focuses that we have, in particular with cost of funds. And we all know, the Fed has raised rates, is looking at raising rates, and we know that cost of funds and low cost deposits are really the bedrock of how we weather any interest rate storm that comes, or any asset quality storm that comes. And so what we're really focused on today is margin expansion. We've had a good run the last few months of raising loan rates while keeping cost of funds down. Cost of funds is going to start moving just because the Fed is moving so hard. So we're watching that as we go. If you'll move to slide 20, tangible book value, you'll see since 2018, we've had a pretty solid increase. You'll note that the backslide in 2022 is really due to the unrealized loss in the bond portfolio. So we don't have any concerns there. It's just the hit to tangible book on the mark to market. So we're still plugging along. Earnings per share in 2021 were $7.23. We feel really good about being there, particularly as we spent in 21 for core conversion and a couple of new markets. And that's rolled into 2022 as we get markets online. So we feel pretty good about where our expense run is today as it relates to being able to play with some operational leverage as we go forward. And with that, I'll turn it back to Scott for slide 21.
All right, let's talk about our overall strategic plan. Most of you've heard what we talked about as it relates to growing into new markets, our core conversion or our core provider, new technology. I would tell you that we continue to invest very deeply in technology as it relates to the internet, our website, and cell phone banking. It's critical to our success. We're not a branch rich organization. We really try to serve, each market very, very specifically. Low cost deposits will remain our main focus as we continue to drive growth in our organization. Obviously, diversifying our loan portfolio. We're in a very fast growing market. We've got to make sure that we continue to try to find those great businesses to bank and become part of our organization. And then lastly, from an efficiency standpoint, we're working really hard to increase our profitability and make sure that we provide a great shareholder return. And that's with that, I'll turn it over to Gary, and then we'll take some questions. Gary.
I think that I think our strategy is a little different than most people, and I've just mentioned for only a moment. So each of our markets, in Arkansas is a small state, right? And each of our markets, each of those towns still has football teams that play each other. They have an identity. And it matters. And so each of our banks in each of those towns has a bank president, they have a loan manager, they have a manager. And so when people walk in to do business, they feel like they're walking into the main location because it is, and we treat it as such. Each of those banks also have a community bank board made up of people in our community that serve on those boards. They're not legal board members, but we pay them a share of stock each meeting. And hopefully they're going to help us make that stock worth more money. We feel really good about that way of doing business, and that's how we've had the success that we've had. We did raise 15 million because we have these 3 new opportunities that we feel really good about, and we wanted to have capital rich when we went down that road rather than wait. The markets obviously with high inflation. The rate would have been worse if I'd have waited until maybe we needed it more closely to the time. So that was the purpose of the way we did it. And last but not least, and certainly not unimportant to our shareholders, we declared a dividend at the end of August and paid $1 a share dividend to shareholders that were, I believe, brand outstanding as of August 31. Is that correct? And so that is our latest and greatest announcement that just went public. And so we've been able to grow quickly through these 3 new markets, and we've been able to pay for it with the core business that we already had established. And all of our numbers are on there. I know you guys all certainly can read. I think our stock sells too cheap, and I would doubt if anybody got on here and said different than that when it's their turn, right?
All right, we're ready to take questions.
Great. Well, thank you for your presentation. A great story. Gary, Scott, also just a personal thank you. You've been very supportive for what we're trying to do, what Julian and I are trying to do, which is bring interesting, maybe unfollowed situations to investors, some under the radar, some otherwise. But again, thanks so much. So let's get right into it. Ross Haberman has a question. How big does Bank OC have to grow in assets or deposits to hit break even? And how much will it cost you this year? And how big can this business get over the next 3 years, let's say?
Yeah, so we model new locations at $50 million in loans and deposits. So we really want each market to stand on its own. So that's the break even that we look at. We kind of feel like something short of 3 years should be a reasonable time horizon. But we're certainly on track to beat that in our other markets. In terms of what Banco C can be, we don't really put a number to what the market is going to be, because we're really going into a market that has been underserved from the standpoint of not having a focused group of people that understand the culture and the language and just how the banking ecosystem is either friendly or unfriendly to these clients. And so when we think about what that market could be, it's certainly going to most likely be a little more consumer based than what we've seen. But certainly any Hispanic business that is out there is really kind of up our alley. And so that's kind of what we're looking for. And
Yeah.
Gary has a
No,
couple
let
of
me
comments
follow.
towards that.
Just, Ross, I think, we have an advisory board. My newest board member, Dr. Adam Arroyos, has been in diversity business up here for many years. And when I asked him to help me, he told me that, his mother spoke primarily Spanish and wasn't comfortable going to the bank without herself. So I asked him to help me build a bank that his mother could go in without him. And that's why he served on our board. So he has 20 people that he helped me put together that the advisory board, and these are executives at these large companies here, Walmart, Tyson Foods, the Procter and Gamble, Kellogg. And so the what I think most people don't really realize is that in every town in America, we have large populations of Hispanic people that are doing a lot of things that no one really knew about, including me. So I, it's how big can this thing get? I mean, anybody that told you that would be lying. The truth is that I know there's an enormous market there, and we're going to do right by that market by serving them with people that look and speak just like them. They're going to be empowered to make decisions to hopefully help continue to build that population. Population of Little Rock, Arkansas, the largest city in our state's 200,000. We think there are more than 200,000 Hispanic people living in Northwest Arkansas. So, man, anybody, again, I wouldn't begin to try to say how big can it get. We want to meet minimum targets. And then I think there's room for expansion in Banco C and other cities in our area. So I feel really good about that.
Okay, we have a hand raised, Kate Blecker. Let's see if Kate can unmute. Let's see, Kate.
Sorry, can you hear me?
Yes,
Yes,
we can,
ma'am.
Kate. Thank you.
Wonderful. I was just curious, you were talked about, you were benefiting from rising rates on your loan portfolio. And then you mentioned that with rates going up, your deposits are going to start costing more. What impact do you think that's going to have on your margin?
Oh, in the short run, we're getting a little bit of margin expansion. We feel pretty good about the health of our margin. But certainly, the Fed is going to act the way they're going to act, and we're going to have to react to that. And so far, because of the liquidity in the market system, most banks have been pretty chill with the amount of rates that they're rising on the cost of funds. But as the Fed pushes rates up and as Treasury rates come up, then there's going to be more pressure on that. But we're just so far trying to buy some more time for the loans and the investment rates to get it higher, and we feel good about achieving that.
And mention your
Darling
Group partner.
Yeah, and so our interest rate risk modeling group and liquidity modeling group is a group called Darling Consulting. We've been working with them for about 5 or 6 years. And so not only do we feel like we're getting a lot of value out of the modeling, but certainly the consulting aspect and their ability to see other banks, see other markets, and then help us feel good about where we're at or where we need to make some changes. So they're a very important part of what we do.
Okay, thank you.
Good. We have a question from Brian Hagel. With the core being one of the largest spends that the bank will have, can you disclose who you're moving from and moving to for your conversion? I guess,
I'd hate to kind of talk about people that we left, but we moved to CSI New Point for digital card and core. We feel like they were the right partner in terms of their size, the types of banks that they're bringing on, and just our ability to have real conversation and real influence at the executive level with them. They've been around for over, I think, 57 years or so. So they're not new to the industry, but they certainly have embraced the open banking concept. And that's really what we were looking for. We've struggled in the past to get to the open banking situation so that we could write some APIs to stub in different fintechs or different products that we need. And so we needed a quicker time to market for that. Not only for the sales piece, but for the back end and the operational piece, because I really believe there's two plays with fintechs. It's one, really automating the back end, and then also putting our salespeople into a better position to win. And there's also, there's a fintech coming sometime in the next 2 or 3 or 4 or 5 years that we can't see, that we've got to be able to grab and plug in. And so that was really the partner that we were looking for.
and where are you in the arc of spending on the technology and systems? Are you halfway, 3/4 of the way? Well, I know you always have to spend,
Yep.
but in this, at least this project.
In terms of the core conversion, I feel pretty confident that we have most of that behind us. We still seem to run into a few computers or tablets, and certainly as we open new markets, we've had to spend a little more on system equipment just to outfit those. But in terms of the core, I feel like we've put a lot of that behind us.
And another question has popped up. Thank you for Ross Haberman. Thanks, Ross, for your questions. How big can Jonesboro and Brinkley grow in deposits and loans over the next 3 years? Do you have any targets?
They're on the same $50 million thought process, but I believe they're going to eclipse that.
The Jonesboro market, greater Jonesboro market's 3 billion.
$3 billion.
Deposits.
So Harrison's $1 billion, Jonesboro's $3 billion. So we feel confident that they can outpace the break-even projections.
I have a quick question about the break even. You said 50 million. I usually think of closer to 30, 35 million. Has the break even amount of deposits been moving up? Has that changed over time, or?
No, I think it's really about the model of being a single office location. And with Jonesboro, with all 3 locations being new marketing to the area, we're really having to build a new brand. So you're really not getting to scale a whole lot of the local market brand. And in particular, as Gary was saying, Jonesboro, Harrison, they're very different situations. And so you're also kind of going into a crowded market for all the right reasons, and you've got to establish. And at the same time, while I feel $50 million in loans is very attainable and very reasonable, we also don't want to take a lot of asset quality risk and push the pedal where it's not prudent. So we want to make sure that we're patient, and that's what the backbone of our legacy markets allow us to do. And they've got growth on themselves. It's not like we're having to go find growth because we can't get it here. We have all the growth we can hope and wish for here. This is really about diversifying loans, deposits, people, geography. It's really a great complement to what we're doing.
Sounds great.
Terrific story. Thanks so much for your time. Julianne?